How does a massive tech company process 19 trillion AI tokens, totally crush Wall Street's earnings estimates by 24%,
Yeah.
and, still lose a third of its market value in just 6 months?
I mean, it's honestly one of the most wild disconnects I've seen in the market recently.
Right. Welcome to the Time in Market Deep Dive. And just a quick reminder before we get into the weeds today, this deep dive is strictly for entertainment purposes. We are looking at some pretty intensive financial metrics, so, always seek professional advice before you deploy any of your own capital.
Absolutely.
So today our mission is to figure out what exactly is going on with Salesforce, ticker symbol CRM. We're cross-referencing their internal cash flows against these fiercely divided Wall Street analyst reports. We want to know, is this a historic overreaction by the market, or are we looking at a legitimate structural death spiral?
Yeah, that's the core mystery. Because the disconnect between the raw financial performance they just reported and the violent market reaction, it's a fascinating case study in market psychology.
It really is. I mean, the numbers they just posted would normally trigger a massive rally.
Oh, without a doubt.
Okay, let's unpack this. For anyone listening, put on your analyst hat for a second. We have a stack of sources here. The Q1 FY 2027 and full year FY 2026 earnings reports, Forex news updates, Benzinga ratings, and an APCR equity research report. And on the surface, the machine is just printing money.
It really is. I mean, if you look at their full fiscal year 2026, they hit a record $41.5 billion in revenue. That's up 10% year over year.
Yeah, and then they roll into this current Q1, reporting $11.13 billion in revenue. The adjusted EPS came in at $3.88, which, it absolutely blew past the consensus estimate of $3.12.
Right. It wasn't just slight beat. They outpaced expectations on almost every traditional metric. Subscription and support revenue increased 14%. They closed 98 separate mega deals worth over $1 million each.
Which means they are still locking in massive enterprise contracts. The business isn't evaporating overnight.
Exactly. They are fundamentally executing on their core business.
But, and this is where it gets crazy, the stock chart looks like a completely different company. It's hovering right around that $175 to $180 mark.
Yeah, which is a brutal 33% drop year-to-date in 2026.
While the S&P 500 and the Dow are out here breaking records, Salesforce is just bleeding out. It's like a commercial real estate company realizing everyone is working from home.
Oh, that's a great way to put it.
Right, like they still have the buildings, the cash flow's clearly there today based on those Q1 numbers we just talked about. But those 10-year leases are about to expire, and Wall Street knows the renewals are going to be brutal.
That is the perfect mechanism to describe what is happening here. Wall Street isn't punishing Salesforce for the cash it generated this quarter.
No, they're terrified of tomorrow.
Exactly. They are pricing in the collapse of the foundational business model that built this $30 billion empire. Because for 2 decades, Salesforce relied on a very simple, highly lucrative equation. 1 human worker equals 1 paid software seat.
The classic seat-based model. You hire 1,000 sales reps, you have to buy 1,000 Salesforce licenses.
Precisely. And it's zero marginal cost software. Once the platform is built, adding 1 more human user costs Salesforce practically nothing. But it generates this predictable, high-margin, monthly recurring revenue.
Right, which Wall Street loves.
But generative AI fundamentally breaks that math. Institutional investors are looking at AI agents that can, completely autonomously resolve customer service tickets or qualify sales leads.
And if you only need a fraction of the human workforce to produce the exact same output, the number of human seats just naturally shrinks.
It shrinks drastically.
Is this like having the best horse-drawn carriage sales right when the Model T drops? Is the fear actually justified given the massive cash flow they still have?
What's fascinating here is that investors are aggressively rotating away from traditional software as a service names and moving toward AI infrastructure. They are demanding that Salesforce prove it can survive the AI native era.
And to their credit, Salesforce isn't ignoring this. They are executing a massive pivot right now with Agentforce.
Right.
They are actively trying to transition from selling those old human seats to selling what they call agentic work units, or AWUs.
Yeah, Mark Benioff is essentially changing the atomic unit of the company's revenue.
Explain that a bit more for us.
Sure. So instead of charging a flat monthly fee for a human to log into the software, they're pivoting to charge per task completed by an AI without any human in the loop.
Wow. Okay.
So if the AI resolves a client issue from start to finish on its own, that is one AWU, and Salesforce bills for it.
And the Q1 data shows this isn't just a theoretical concept anymore. Agentforce ARR, their annual recurring revenue actually had hit $800 million.
Which is a 169% year-over-year growth rate. It's scaling fast.
Yeah, and combined with Data 360, their total AI and data ARR is over $2.9 billion. They've delivered 2.4 billion of these AWUs and processed 19 trillion tokens.
But, and this is the big, but that 169% growth in Agentforce brings up a massive margin problem.
Right, because if I'm an investor, how do I value an agentic work unit compared to a traditional software subscription? Especially if Benioff is paying Anthropic $300 million just for token usage. How does that impact the bottom line compared to their old zero marginal cost seats?
That right there is the structural risk terrifying the market. AI is not zero marginal cost.
Not even close.
No. Every single time an agentic work unit is executed, compute power is consumed, tokens are processed. By committing $300 million to Anthropic, Salesforce is basically acknowledging that they have to pay a foundational model provider a toll for the underlying intelligence.
So even if they successfully transition a massive enterprise client from, let's say, paying for 1,000 human seats to paying for 500,000 AWUs, the gross margin profile on those AWUs is inherently lower because of the heavy compute costs.
Exactly. It changes them from a pure software company into something resembling a highly customized wrapper around external language models, and that adds a massive layer of risk.
Plus, you have the enterprise procurement freeze happening right now. The sources highlight that IT spending is getting soft across the board.
We are seeing this industry-wide. Microsoft, Oracle, ServiceNow, they are all quietly noting that deal cycles for AI tools are elongating.
Because no one knows what to buy yet.
That and procurement teams at Fortune 500 companies are just overwhelmed. You can't just plug an autonomous AI agent into a messy, outdated legacy database and expect it to work.
Oh yeah, data is usually a disaster.
Right. Companies have to spend months cleaning up their data hygiene before they can even think about deploying something like Agentforce. So the adoption curve is hitting this massive bottleneck.
Which means the legacy human seat revenue might bleed out faster than the new AWU revenue can scale up to replace it.
Exactly.
Okay, let's look at how the market is actually pricing that transition risk by checking the valuation multiples. Right now, Salesforce has a PE ratio of 44.10.
Which tells a very specific story when you compare to the industry.
Yeah, and their EV to EBITDA is 23.90. Plus, they have a price-to-sales ratio of 7.35.
To really contextualize those numbers, you have to look at their peers navigating the exact same AI landscape. SAP is currently trading at a PE of 95.70.
Double Salesforce.
And then Palantir is commanding an astronomical PE of 509.21.
Wait, really? 509?
Yes, because Wall Street is pricing Palantir as the foundational plumbing of the AI era, assuming absolute hypergrowth. So next to that, Salesforce at 44.10 looks incredibly compressed.
Yeah, they're sitting at a $267.8 billion market cap, wedged right between ServiceNow at $172 billion and Oracle at $415 billion.
Right.
Here's where it gets really interesting, though. I want to push back on the idea that they are just automatically undervalued, because we have to look at capital efficiency.
Let's do it.
They have an operating margin of 20.3% and a massive gross margin of 77.3%. So on paper, the profitability is clearly there.
It is.
But their ROA, their return on assets, is sitting at a pretty dismal 6.11%. Why are they lagging so far behind high-growth peers like Intuit and Palantir on basic efficiency metrics if their gross margins are still intact?
If we connect this to the bigger picture, it comes down to top-line deceleration and a bloated operating structure. Salesforce's revenue growth rate has cooled off to 7.6% year over year.
Oh.
Yeah, when you compare that to SAP growing over 10% or Intuit over 17%, it becomes clear that Salesforce has reached a maturity plateau.
So they aren't the young, scrappy, hyper-growth company anymore.
Exactly. Because they're no longer putting up hyper-growth numbers, the market is actively re-rating them. Institutional money is stripping away that premium growth multiple and treating Salesforce as a traditional value and stability play in the tech sector.
Which is why this stock is getting hammered. It's experiencing multiple compression while simultaneously trying to fund this existential AI pivot.
It's a tough spot to be in.
So to cut through the noise of the multiple contraction and the AI hype, we have to look at the raw mathematical floor. The APCR Equity Research Report provided this highly detailed 5-year DCF analysis.
And a DCF, a discounted cash flow model, strips away all the market sentiment. It simply asks, based on the actual free cash flow this business generates, what is one share intrinsically worth today?
Let's walk through the exact inputs because this really dictates our final verdict. The APCR model uses a pretty conservative terminal growth rate of 3%.
Which is standard for a mature company.
Right. And they use a weighted average cost of capital, or WACC, of 9.84%.
And for you listening, a 9.84% WACC essentially means investors are demanding almost a 10% return right now just to stomach the risk of holding Salesforce through this messy AI transition.
So it's a reasonably elevated risk premium.
Exactly. It's not a risk-free bet.
Okay, so using that discount rate, the model projects the present value of their free cash flows over the next 5 years to be $61.07 billion.
Right.
And then they apply that 3% terminal growth rate to calculate the terminal value, basically estimating what the cash flows will be worth in perpetuity after year 5. That comes out to $233.35 billion.
So you combine those two numbers.
Yep, you combine them, adjust for net debt, divide by the outstanding share float, and the implied intrinsic share price lands at $221.82.
$221.82. That is the strict mathematical value of the cash the business is projected to produce.
Completely ignoring the fact that the stock is currently trading around $175. It's like finding a house mathematically appraised at $221,000, but it's currently listed on the market for $175, just because the neighborhood is undergoing some zoning changes.
That's a perfect analogy. The discount is massive.
But I do have to challenge this model, though. Is this $221 intrinsic value a complete hallucination?
How so?
Well, a DCF assumes a relatively smooth continuation of cash flows. Does this DCF model fully capture the risk of the AI transition, or is it assuming way too much stability? Because if the enterprise transition from human seats to AWUs is messy, or if procurement teams freeze up for another 18 months, that free cash flow baseline evaporates.
That is the exact debate happening on trading floors right now.
I mean, how can we trust a 3% terminal growth rate when the fundamental product delivery mechanism is being ripped down to the studs?
The defense of that 3% terminal rate relies entirely on ecosystem stickiness.
Stickiness.
Yes. Salesforce is not just a tool you can swap out over a weekend. It is the central nervous system for thousands of global enterprises. The switching costs to rip out Salesforce and migrate to a competitor are astronomically high.
Oh, that's true. It would take a massive corporation years to move their data.
Right. So the DCF assumes that even if the pricing model shifts to AWUs, those massive enterprise clients are not going to churn. They will just transition their spend within the Salesforce ecosystem, defending that free cash flow baseline.
Okay, so the DCF gives us a mathematical anchor, but it really relies on management flawlessly executing this pivot, which explains the massive divide in analyst sentiment we're seeing.
The spread is huge.
Yeah, you have Bank of America coming in with a super bearish $160 price target. They specifically downgraded the stock because they see the exact structural growth risks from AI that we just discussed.
And then on the other end of the spectrum, JMP Securities is maintaining a wildly bullish $430 price target.
$430, that's optimistic.
They are essentially betting that Agentforce becomes the dominant AI consumption model for the entire enterprise sector.
But if you aggregate all 35 major analysts covering the stock, the consensus lands right in the middle at $273.68.
Which is still significantly higher than where it's trading today.
Yeah, even with the bears factored in, that consensus is nearly $100 higher than the current price.
Yeah.
And management is obviously seeing this same massive discount because Benioff just announced a colossal $50 billion share repurchase program.
This raises an important question, though.
Right, because a buyback of that magnitude usually signals absolute confidence that the stock is undervalued. But looking at their history, it feels a bit like smoke and mirrors to me. Are they actually returning value to shareholders here, or is there a structural catch?
There is a massive catch, and it has to do with how tech companies compensate their talent.
Walk us through it.
So a $50 billion authorization sounds historic, right? Makes great headlines, but there is no legal timeline binding them to execute it rapidly. They aren't locked into spending it all this year.
Right.
More importantly, look at the mechanics of their previous $28 billion buyback program. They deployed $28 billion into the open market, but it only shrank the actual outstanding share count by roughly 4%.
Wait, 4%. Where does the rest of that money go? How do you spend billions and barely dent the float?
It goes entirely to offsetting dilution from stock-based compensation.
Oh, of course.
Salesforce, like most massive tech firms, issues a staggering amount of equity to retain top executives and engineers. When they execute a buyback, they are largely just buying back the new shares they just printed to pay their own employees.
Wow. So it prevents the existing float from diluting further, but it doesn't significantly shrink the supply of shares enough to forcefully drive up the price for everyday retail investors.
Exactly. The buyback is essentially an engineer retention fund masquerading as shareholder yield.
That dramatically changes how you view that $50 billion headline. It's really a defensive maneuver to tread water, not an aggressive offensive push to squeeze the stock higher.
Precisely. You cannot rely on the buyback to generate the alpha here. The investment thesis has to rest entirely on those valuation metrics and the success of the underlying AI pivot.
Okay, which brings us to the final synthesis and the verdict. Let's pull all these threads together. We have a stock down 33% this year, hovering around 175 to 180. The 5-year DCF models an intrinsic value of $221.82, and the analyst consensus sits at $273.68.
When you isolate the math, the current stock price represents a massive, undeniable discount to its calculated intrinsic value. The market has aggressively priced in a worst-case scenario regarding the AI disruption.
They priced in maximum fear.
Exactly. Because of that severe multiple compression, the margin of safety is remarkably high right now. Based strictly on valuation, the verdict is a UI, or a very strong hold, if the stock is already in your portfolio. This aligns perfectly with the conclusion of the APCR equity research report.
So what does this all mean for you as an investor? You are essentially buying a highly profitable, sticky enterprise ecosystem at a distressed valuation. But that BUY rating carries a mandatory assumption.
A huge assumption.
Right. You have to believe that the transition to agentic work units will succeed, and that the gross margin compression from AI compute costs won't completely erode their free cash flow.
You are fundamentally betting that Mark Benioff can replace a dying zero marginal cost business model with a consumption-based AI model without losing the enterprise customer base.
It's a high-stakes bet.
It really is. Which brings up a final paradigm shift I want you to consider.
Okay, lay it on us.
For the last 20 years, the most valuable software companies on Earth generated wealth by selling digital tools for human beings to use. They sold the digital hammer to the human carpenter.
The ultimate SaaS model.
Yes. But if Agentforce succeeds and charging per autonomous work unit becomes the industry standard, the fundamental nature of software changes completely.
How so?
The next era of enterprise technology won't be about selling digital tools. It will be about selling digital employees.
Oh.
The question you need to ask yourself as an investor analyzing Salesforce today is this. Are you ready to stop investing in tool makers and start becoming a landlord of a digital workforce?
That completely reframes the entire AI transition. It's not just a software update, it is a labor replacement model. Incredible stuff. Well, thank you for joining us on this deep dive into the mechanics of Salesforce and their AI pivot. Keep questioning the consensus, keep looking past the noise, and we will catch you on the next one.